Do you want to sell put options but think maybe your brokerage account is too small? Or maybe you want to protect your capital and trade for very little money? Well, if so, you've come to the right place. Hi everyone, my name is Rick Orford and welcome back to my channel. I'm the author of the Financially Independent Millennial, and for this video I will be your guide. You'll be learning how to generate some additional income by selling put options even if you have a small account. In case you're wondering what I know about selling put options, well, I've been trading options and stocks since 1996. I'm also a Wall Street Journal best-selling author and love to create content about creating income. My videos have been viewed hundreds of thousands of times, and my work is covered on some of the most authoritative websites, including Yahoo Finance, NASDAQ, and Business Insider. So you can trust that I know what I'm talking about. But here's a quick disclaimer. While I'm passionate about sharing what I've learned through years of trading, I'm not licensed as a financial or investment advisor. Think of this as a conversation with a friend who's been trading stocks and options on his own. Okay, so let's jump right on in. Selling put options can be an excellent way to create a new source of income. However, selling put options can be very expensive. If you're assigned, you'll have to buy the underlying stock or security should the trade go against you. Now, I don't want to scare you, but if you're assigned one contract for a stock, let's say with a $50 strike price, it'll cost you a whopping $5,000. And if you wrote 4 puts, well, you'd be looking at a $20,000 bill. Now, I get it. You may not have $20,000 or even want to spend $20K, especially if you're just starting to learn about selling put options. So before you hit stop or move on to another video or give up, stick around because you'll learn how to significantly reduce the risk of assignment and make some extra money by selling put options in your brokerage account. And actually, I'm going to show you an example that I literally found in a few seconds that will let you sell a put option with just $500 in your brokerage account. And to do that, we're going to be using what's called a credit spread the right way. Okay, so if this is your first time working with put options, or maybe you've never sold puts before, put options give the buyer the right to sell the underlying stock at the strike price at or before expiration. So you, the seller or the writer, you take the responsibility for buying the stock should your option get assigned. Now, your goal when selling puts or call options is for it to expire unassigned or worthless. And when that happens, you make the most amount of money. Now, you may have read on some forums that short puts have unlimited risk. The truth is, maximum losses are capped at the strike price multiplied times 100 times the number of contracts sold. And this is your maximum risk scenario. It only happens if the underlying stock goes to zero at or before expiration. And still, as you can see on this graph, the maximum loss of a short put can be still quite high, but it's not unlimited. And that's why we're going to be looking at a credit spread today. Selling credit spreads means buying and selling an option to create a credit, that's money that you get to keep no matter what happens. Credit spreads are available for both call and put options, and since this video is about selling puts, we're going to be talking about the put credit spread, which is also known as the bull put spread. What I love about bull put spreads, well, there's two things. One, you can sell them using a small account. And two, they cap your potential losses because the risk is defined. A bull put spread is a combination of two put options. You sell one and buy another at a lower strike price. With a bull put spread, you have the short put, where your potential income will come from in the form of premium that you receive as soon as you initiate the trade. The other is the long put, and it's going to be for the same underlying stock with the same expiration, but at a lower strike price. So you're selling a put and buying another at a lower strike price with the same expiration, all on the same order. Now, with a long put in place below your short put option strike, your trade has an ironclad stop loss, allowing you to sell put options even with a small account because it limits you the risk that you would have in a naked or cash secured put. However, this protection doesn't come free. Since you'll be buying a put, you're going to need to shell out a portion of the premium that you receive from that short put. And the difference is yours to keep, which is why a bull put is called a credit spread. Now, in case you're wondering why it's called a bull put, that's because you profit when the markets, or whatever the underlying security is, stays above the strike price. The graph then, will look something like this. The green line represents your profit, and the red line represents loss. As long as the strike price stays above the break-even point, which is the premium less the short strike price, you'll be profitable. Bull put spreads earn you money through premiums, so you'd want to use this strategy when you think that the asset will experience a moderate price increase. And you'll notice that I used the word moderate. Let me explain. Bull put spreads have capped maximum profits, which we'll compute in a bit. But as long as the underlying stock's price stays above the short put strike, you get to keep the maximum profit and earn nothing else, no matter how high the stock climbs. So any significant increase above the short put strike represents what we call an opportunity loss. Because if you were bullish on the stock, you would have earned a lot more if you had bought a call option instead or just owned the stock outright. But who cares? This trade is about earning income by selling put options with a small account, right? So you might be wondering if you can also use technical analysis on the underlying stock to improve your chances of maximizing profits from selling puts with that small account. And if you're wondering, well, the answer is yes. Some technical analysis indicators are moving averages, which is what you'd want when selling puts. The relative strength index, or the RSI, or the moving average convergence divergence, the MACD, are two indicators that can provide you some insight into the direction of the stock's movement. They indicate support areas, like RSI can show oversold levels, and MACD can display potential opportunities for upward price movement. RSI is a volume indicator, and a reading of 70 or over is usually seen as overbought, meaning the stock is at risk of falling. And an RSI of 30 or below means that the stock is oversold. So what does that mean to you? Well, we'd want to look at stocks that are oversold but moving up above their 30 line. And if you sell a put option on a stock that's moving above its RSI 30 line, well, it'll have the potential to do well. And then we have MACD. That's similar to RSI, only it factors in trading prices instead of volume. So if a stock is moving above its trading line, well, that could be another good target. And then, of course, if you find a potential stock using RSI and MACD together, well, you'll narrow your options, but you'll have much better chances of success. And by the way, I'll leave a link in the description that explains more about RSI and MACD. But remember, no indicator is 100% perfect all the time, and they're more like educated guesses, like data-driven guesses, than crystal balls that tell the future, right? Still, selling put options with small accounts doesn't have to be a guessing game or gambling. So maximize the use of your tool set to guess the best possible result. At least that's what I do. While an index like the S&P 500 acts as a barometer for how the market is doing, individual stocks and asset classes, well, they follow their own trajectories. If you're selling puts with a small account, you're going to want to avoid losses like the plague, and you need to protect your money as best as you can. And that's why I like to select my bull put trades on a case-by-case basis to maximize income potential. However, I don't have the time to comb through all the available stocks and then look through all of their different options chains to find a bull put that I could sell. I mean, because even if I did, by the time I'd find the trade, well, the opportunity would probably be gone. It would probably be too late. And that's why I always like to use an option scanner to find potential trades. It's kind of like a search engine for potential trades. And my favorite one is called Option Samurai, that uses AI to find viable options trades based on my preferred strategy. And it's easy as just a couple of clicks and a mouse, and I can trade based on that live data right away. Option Samurai has a default set of values for filters when you're scanning for specific strategies. So you can more or less review the results of the option scan and start using them for your trades. It's really that easy. For me though, default values aren't really enough. I like to fine-tune my scans this way it gives me the best possible chance of walking away with all of the profit. So let's look at some of the filters that I consider when looking for a bull put spread. And the first is going to be implied volatility, or its IV rank. And this is an options trading metric that gives traders an idea of how a specific option might move. On Option Samurai, IV is proportional to premium prices. So the higher the IV, the higher the premium prices, and the higher potential earnings for traders selling puts with small accounts. However, you need to remember that IV is not directional. The underlying of a high IV option can move up or down, so they're very, very risky. To change your scan's implied volatility, click the IV rank and input your desired value. And I'm going to use 40 for a conservative IV setting. The second and more straightforward filter that I like is the probability of max profit. And it's exactly as the name says. It's the probability that we'll keep all of the premium. And to change that, we're going to click the probability of max profit filter and set the slider to your desired value. For bull puts, I like 70%. This means Option Samurai will scan the market for trades with a 70% chance or higher to keep all of the premium. Pretty cool, huh? Oh, and always remember to click Run Scan every time you change a filter so that the changes are applied and then you see the new set of trades that you could possibly execute. Now that we have some potential options trades, let's start with the examples. Let's say you have a small account. Maybe you have $500 in your brokerage account and you want to sell bull put spreads. In this case here on Option Samurai, we see that the SPY comes up, and I'll choose it. And the SPY is the exchange traded fund that tracks the S&P 500. As you can see, this trade has a 70.78% chance of maximum profit of around $101. This is the premium you get to keep. So once you click SPY, Option Samurai will give you the steps, or the legs, of the bull put spread. Okay, so let's break it down for the trade. So here, Option Samurai suggests buying the SPY put option with a $507 strike expiring in about 2 weeks, so April 19th, for between $1.39 and $1.41. So let's use $1.40 as the midpoint. The next step is writing a put option with a $513 strike for $2.42, and this is the premium. And same underlying and expiration date, of course. Now, you might wonder how to do this with your own brokerage account. In general, if you're set up for options trading, you're going to issue what's called a sell to open order for the put option that you're selling, and a buy to open order for the put option that you're buying. And it's like this for my Canadian Scotiabank and Royal Bank accounts, Interactive Brokers, and it's going to be similar with all of the other brokerage, or many of them, like Schwab, Thinkorswim, Tasty Trade, Robinhood, Webull, and so on. Now, speaking of orders, there's actually two things that's super important to know when selling bull puts. First, you must use a limit order when buying and selling options. Actually, I'd say for any trade, stocks, options, or whatever, always use a limit order. This way you buy or sell the security at a specific price or better. And if you use a market order, there's a chance that you could get a really terrible price on the trade. So definitely use a limit order. And second, if you're using an options-friendly broker like Interactive Brokers, you can both buy and sell the puts at the same time. So you specify the limit price for the trade and for how long the trade is good for. For example, you can select GTC, which means good till canceled, or day, which means good till the end of the trading day. In the SPY example from before, you could enter a trade with a limit order of $1 or $100 in premium that's good until the end of the day. And as soon as a trade becomes available, you'll get filled, meaning you'll get $100 in premium. For reference, I ran the scan on April 4th, and these two trade legs have the same expiration about 2 weeks from now, on April 19th. Now, you don't have to stick with a 2-week expiration date. Options Samurai allows you to set your expiration dates, or your preferred expiration dates, whether they be monthly, weekly, or every other month, half a year or longer, more than a year. Those are called long-term equity anticipation securities, or LEAPs. And by the way, if you want to know more about LEAPs options, you can check out this video up here. However, with the spread, I like to pick options with 2 or 3 weeks out for expiration dates. That way, you can make more trades within any given month or year. Now, to get the maximum profit on this bull put spread, the underlying stock's price must stay above the short put strike price of $513 at expiration. The maximum profit is calculated by taking the premium received for the short put and then subtract the premium paid for the long put, and then multiplying it by 100 for every bull put spread you sell. So in this case, you'd get $102 per contract. And again, this trade has a 70.78% chance of you achieving maximum profit. That's good odds, if I do say so myself. The break-even price on a bull put spread is calculated by taking the short strike's price and subtract the net profit received, or the premium. In this case, it works out to $511.98. So losses will start if the SPY moves below 511.98. The maximum loss of a bull put spread happens when the underlying security's price goes to or below the long put strike price. So in this case, if the SPY drops to or below $507, well, that's your maximum loss level. The maximum loss is calculated by taking the difference between the short and long strike and then subtracting the net profit. So for this trade, the maximum loss per contract would be $498. And the $498 is the minimum amount that the brokerage will require you to keep as collateral. Now, you might be asking, why is the maximum loss so much bigger than the maximum gain? Well, that's the trade-off of having a higher probability of pocketing the maximum gains. And again, the chances of maximum loss is quite low, less than 16%. And your small $500 account can cover the potential loss for selling that bull put spread. Now, you might also notice that the entry price for the bull put spread is, well, almost free except for fees and commissions. So you can write multiple bull puts to increase your profit potential, but always remember that you do need enough cash or margin to cover your trade should it go against you. Now, even with the highest probability of winning, there is always that non-zero chance that you might face a loss. Thankfully, you can adjust your bull put spread to avoid taking a loss in your account. And the first way to do that, if a trade is moving against you, you might want to try adjusting or rolling down your strike prices. To do this, you'll close out your bull put spread by issuing buy to close and sell to close orders on your short and long positions respectively. This closes out your trade, and if the stock is lower than it was when you initially sold the spread, well, you might end up losing a little bit of money. But because you're selling a credit spread, you'll never lose more than the maximum loss value. Then you can sell another bull put spread with lower strike prices to offset your losses from rolling down. But again, watch the probabilities that you'll find in the scanner. Another option is to close your positions like I just mentioned, and then sell another bull put spread with different expiration dates and perhaps different strike prices. And if I happen to have itchy fingers at the time, I might take some chips off the table when I can buy back my trade for 20 cents on the dollar. In other words, I keep 80% of the premium. For example, let's say you collect $100 by selling a bull put, and then fast forward a little bit, you can close out the trade for $20. Well, then you can sell another. And some brokerages, like Interactive Brokers, well, they allow you to set profit-taking orders at the very beginning of the trade. That way it automates the whole process. I mean, that's not a bad exit strategy, right? Another thing you could do to avoid losses is to add a bear call spread to your bull put, and that turns it into what's called an iron condor. The bear call is the opposite of a bull put and works when stocks stay below a certain strike price. So if you sell a bear call and a bull put, which is an iron condor, that becomes a neutral option strategy. And if you sell an iron condor, you'll earn a maximum profit when the underlying stays within the range of your short options. And by the way, you can learn more about iron condors in this video here. Selling put options can be an excellent way to earn money during rising markets and with a small account, or at least having very little money at risk. Yes, selling puts comes with risks, but all trades do. However, with the right tools, including the right scanners and technical analysis tools, you can improve your chances of walking away with profits. Now, I'm curious to hear about your experience trading options. What's been your biggest takeaway today? Do you have any tips or questions to share with the community? Let's keep this conversation going in the comments below. Well, that's what I've got for you today. Thank you so much for watching. If you found this video helpful, please give it a like, share it with your fellow traders, and if you already haven't done so, don't forget to subscribe for more insights into the world of selling stocks and options. Until the next time, keep trading smart and stay disciplined. Bye.